Welcome to Section 8, the final content section of our ASC 718 training series. In this section, we bring together how SBC appears in the financial statements, what disclosures the standard requires, where US GAAP and IFRS 2 align and diverge, the most common mistakes practitioners make, and what auditors will expect to see when they review your SBC accounting. This is where everything in the series comes together. By the end of this section, you will be able to identify where SBC expense appears across all three financial statements, describe every disclosure that a SC 718 requires and why each one matters, explain the key differences between US GAAP and IFRS 2, recognize the most common SBC mistakes and how to prevent them, and prepare the documentation package that auditors expect to see. The income statement rule is intuitive once you understand the principle. SBC expense sits in the same line as the cash compensation paid to the same employees. If engineers receive RSUs, the expense goes into cost of goods sold alongside their salaries. Research staff options go into research and development. Sales team awards go into selling and marketing. Corporate and executive awards go into general and administrative. There is no separate SBC line on the face of the income statement unless the company chooses to present one, and that choice must be applied consistently. On the balance sheet, equity classified awards accumulate in a PIC stock-based compensation as you recognize expense each period. When awards vest or options are exercised, that balance is reclassified into common stock at par and a PIC common stock. Liability classified awards appear as a liability, current if expected to be settled within a year, non-current otherwise. They can be presented as a separate line item or included within accrued compensation, depending on the entity's preference, but the classification between current and non-current must reflect the expected settlement date. The cash flow statement has several SBC-related line items, each in a different section. SBC expense is non-cash, so under the indirect method you add it back in operating activities to reconcile net income to operating cash flow. When employees exercise stock options, the cash received is a financing inflow. When the company withholds shares and remits cash to tax authorities for RSU vesting, that payment is a financing outflow. Excess tax benefits from SBC, introduced to operating activities by a SU 2016-09, are also presented in operating activities. A SC 718 requires some of the most extensive disclosures in all of US GAAP. The standard is designed to give financial statement users enough information to understand what kinds of awards exist, how much they cost, what assumptions drove the valuations, and what unrecognized cost remains for future periods. These disclosures are required whenever there is SBC activity. They are not optional, and they apply in both annual and interim financial statements. Think of the disclosure package as telling the full story of your equity compensation program. Starting with the plan-level disclosures, you must describe all equity compensation plans, including the types of awards they permit, the vesting conditions attached to each type, and the maximum contractual term of options. You must disclose the weighted average grant date fair value for awards granted during the period, broken out by award type. Total SBC expense and the related income tax benefit must be presented by income statement line, COGS, R&D, and so on. And for any award valued using an option pricing model, you must disclose all 6 key assumptions: expected volatility, expected term, risk-free interest rate, expected dividends, and any others used. The option roll forward is one of the most visible disclosures. Opening balance plus grants, minus exercises, minus forfeitures and expirations, equals ending balance outstanding. For outstanding and exercisable options, you must also show the weighted average exercise price and remaining contractual term. You must disclose the total intrinsic value of options actually exercised and RSUs that vested during the period. This tells users the real economic benefit delivered to employees. And critically, you must disclose the total unrecognized compensation cost for awards that have not yet vested, along with the weighted average period over which that cost will be recognized. For liability classified awards, the disclosure requirements include the fair value of those awards at period end, because unlike equity awards, the measurement does not freeze at grant date. You must also disclose the method used to determine that period-end fair value, which is important because the remeasurement drives the income statement volatility that readers need to understand. If any liability awards are vested but not yet settled, disclose their intrinsic value. These disclosures are presented separately from the equity award disclosures to avoid confusing two very different measurement frameworks. A key point for practitioners who work with both US GAAP and IFRS 2. The core model is identical. Both standards require recognition of grant date fair value over the requisite service period. Both treat market conditions by baking them into the grant date fair value, so expense is recognized regardless of whether the market hurdle is met. Both exclude performance conditions from the fair value calculation and instead estimate the number of awards expected to vest, updating that estimate each period. And both use the incremental fair value model for modifications. The convergence between the two standards is substantial at the foundational level. The key differences between US GAAP and IFRS 2 center on three areas. First, forfeitures. Under US GAAP, a SU 2016-09 gave companies a policy choice: either estimate forfeitures up front or recognize expense and reverse it when actual forfeitures occur. IFRS 2 does not offer that election. Estimation is required. Second, tax effects. US GAAP routes all excess tax benefits and shortfalls through income tax expense on the P, and IFRS 2 routes the tax benefit that corresponds to cumulative SBC expense through equity, with only the excess going to equity as well, a fundamentally different presentation. Third, group share-based plans get more explicit treatment under IFRS 2, which can matter for multinational entities. The most serious mistake is not recognizing SBC expense at all, treating equity awards as zero cost, because no cash leaves the company. SBC is a real compensation cost and must be measured and recorded. A close second is continuing to expense an award after the employee has forfeited it. The moment an employee leaves and unvested awards are canceled, reverse the cumulative expense immediately. Third, using intrinsic value rather than the BSM or Monte Carlo fair value for options. At-the-money options have zero intrinsic value but significant time value. Intrinsic value alone dramatically understates the cost. And fourth, failing to accelerate expense to the retirement-eligible date when the employee could retire before the end of the nominal vesting period. Two condition-related mistakes cause recurring audit findings. First, for market conditions, expense is always recognized over the service period, even if the stock price hurdle is never reached. Do not reverse market condition expense on failure. For performance conditions, the opposite applies. If the performance target is not met and awards are forfeited, reverse the cumulative expense. Second, in an engagement subject to US GAAP, do not default to the IFRS forfeiture estimation requirement. Confirm the entity's elected policy under a SU 2016-09 and apply it consistently. And on presentation, do not place SBC in a standalone income statement line without first establishing and disclosing that as a policy election. Auditors approach SBC with a structured documentation checklist. They expect to see the complete award documentation package, the equity plan documents, individual grant agreements, board resolutions approving the grants, and cap table entries. For fair value, they want the full BSM or Monte Carlo model with all 6 inputs documented and each input supported historical volatility calculations, risk-free rate sources, expected term analysis. They expect an award roll forward that begins with the opening balance, adds grants, subtracts forfeitures, exercises, expirations, and ties to the closing balance, and that closing balance must agree to both the cap table and the general ledger. The unrecognized compensation cost calculation must also tie directly to the disclosed amount. SBC accounting requires clear role accountability. Team members perform the initial identification, classification, and recording, prepare all supporting schedules and reconciliations, and flag any unusual items to the team lead immediately. Team leads review all classifications, journal entries and work papers, review disclosure drafts, and escalate any judgment-based conclusion or significant estimate to the manager before it goes to the client. Managers approve all judgments and significant estimates, review and approve all financial statement disclosures, communicate significant accounting decisions to client management, and sign off before issuance. The period-end checklist ensures nothing falls through the gap. New grants, expense calculations, retirement eligibility assessments, performance condition updates, forfeiture reconciliations, DTA roll forwards, and diluted earnings per share updates. Let us bring the series home with the final takeaways. SBC expense belongs in the same income statement line as the cash compensation of the employees who received those awards, not in a standalone line. ASC 718 disclosures are among the most extensive in US GAAP. Plan descriptions, fair value assumptions, roll forwards, intrinsic values, and unrecognized compensation cost all belong in the footnotes. US GAAP and IFRS 2 share the same core model but diverge on forfeitures, where IFRS requires estimation, and on tax effects, where US GAAP routes everything through the income statement. Never reverse market condition expense regardless of outcome. Always reverse performance condition expense when the target is not met. An audit readiness is not a last-minute exercise. It requires complete, contemporaneous documentation from the date of grant through the date of settlement. Thank you for completing this section on presentation, disclosure, IFRS, and audit readiness. Thank you for watching. Subscribe for more training from PNJ Group.